Hi, everyone. Welcome to the latest in Beacon's webinar series, Preparing for Volatility, Engineering Custom Scenarios for Commodity Books. My name is Mark Higgins. I'm co-founder and chief analytics officer here at Beacon. Thanks for joining us today. Today, we're going to talk about the challenges of managing commodities risk and how to approach those challenges. Commodities markets often have a lot more risk factors than traditional financial markets. That means when you look at a typical risk report for a commodities book, you'll see lots of numbers. These are called the Greeks, deltas, vegas, gammas, and all that kind of stuff. These are fundamental risk numbers that everyone should track, but sometimes it's tricky to interpret them because there's so many of them. So we'll go through a typical risk report showing Greeks to give you a feel for why there are so many numbers. And then we're going to talk about how to get rid of a lot of them. That is, how to approximate risk through dimensionality reduction techniques, both simple ones and more quantitative methods. We'll look at one in particular, principal component analysis, and see how you can use it to kind of poke and prod at your portfolio's exposure to different kinds of realistic curve shock scenarios. We'll also look at historical scenarios to understand your risk, both through standard metrics like value at risk, and also by looking at specific historical scenarios and seeing what would happen to your book if they were to happen again. We'll do that by building a custom app in Beacon that lets a risk manager easily pick out those historical scenarios and apply them. So let's go over the problem again. In financial markets like foreign exchange or equities, you can store the underlying asset easily and at the scale of the market. And that means you can arbitrage different points on the forward curve, and that arbitrage can happen at a large enough scale that the market closes those arbitrages. Imagine you've got a market where the one-year forward price is well above the spot price. If that's the case, you can buy the asset today, sell it forward through the forward contract, and then store your asset. When the forward comes to settlement, you pick your asset out of the storage and deliver it into the forward contract, and you make a risk-free profit. If there's enough storage available, people will keep on making that trade over and over, and through those trades, the spread between the spot and forward prices will close. Then the spot and the forward prices will be very closely linked. When one goes up, the other goes up by the same amount, basically. That means that the correlation between moves in different forward prices is 100%, and that all the forward prices have the same volatility. However, if there isn't much storage capacity available, then that arbitrage trade won't be enough to close the gap. And what that means is that spot and forward prices, or different points on the forward curve, can all move somewhat independently of each other. And that's the case for most commodities markets. There's some exceptions like precious metals that acts pretty much like a currency. Base metals, you can arbitrage a contango curve but not a backwardated curve. But for a lot of commodities markets like oil or natural gas or electricity, the available storage capacity is tiny compared to the size of the market. So for those markets, the different forward prices don't move in lockstep with each other because there's no arbitrage that kind of forces them to. Their moves are typically positively correlated, but with well less than 100% correlation. And what that means is that all the forwards are separate risk factors. So you don't have just one delta in a commodities market like you do with an equities market. Instead, you have one delta per forward contract. Most markets trade on futures exchanges, so we'll use futures and forwards kind of interchangeably here. So ultimately what you have is one delta per futures contract. Here's an example of a commodities risk report. It's a delta report. For a simple case, this is a portfolio of swaps on WTI crude oil, which is represented through the CL contract on the CME. Just as a reminder, delta gives linear risk to a market price. So here, for example, the risk to the June 2023 futures contract is 102, which means that your risk to the June 2023 futures price moving is the same as if you were long 102 lots of that future. And you can see there's a different delta for every different futures contract this portfolio is exposed to, not just one delta for WTI overall. Here there's 2 years worth of monthlies, and so that's 24 different numbers. So if there's n points in the futures curve, there are n deltas. So here n is the number of futures contracts you have risk to. So if there's 2 years of monthly contracts, that's 24 different deltas. It gets even trickier for other Greeks like gamma. Gamma expresses how much your delta changes as the underlying asset price moves. That's important for things like options risk. So if there's n futures prices, there are n regular gammas. Like one of them would be your gamma to the June 23 price, which means how much your June 23 delta changes when the June 23 futures price moves. But there's also cross gammas. So you might have risk where your June 23 delta changes when the December 23 futures price moves. Those cross gammas are zero for simple vanilla options, but non-zero for a lot of complex but still common structures like swaptions. So in general, if you've got n futures prices, you have n times n minus 1 over 2 gammas, sort of like n squared over 2 gammas. That's a ton of gamma numbers. There's a lot of numbers. And we've just been looking at one market, WTI crude oil. Many commodities portfolios have risks to lots of different markets. So you can imagine the number of risk factors that you see in these Greek-based risk reports can get pretty huge. So imagine you're a risk manager on a commodities trading desk looking at a Greek-based risk report and seeing dozens or hundreds of numbers representing your risks along all these different axes. Now, sometimes you'll have concentrated risk positions where only a few numbers matter. And so you do always want to look at those complete Greek-based risk reports. But often your risk is distributed pretty broadly. So then what do you want to do if you want to hedge your risk away? Realistically, you're not going to try and make all those risk numbers zero by doing a trade for every single one. It's just too many trades to do. Instead, you'll look for ways of reducing all those risk numbers down to some sort of smaller set of summary numbers. I'm a quant, so I like kind of mathy words. So let's call this exercise of reducing the number of risk factors dimensionality reduction. You're reducing the number of your risk dimensions from hundreds down to something a human can sort of actually deal with, like a handful. So let's flip back to our delta report. There's lots of numbers here, but there's one at the bottom called total, which just sums up all the other numbers. This is a simple form of dimensionality reduction. What it shows you is the delta to a specific type of curve shock, which is a parallel shift. That is, if the whole futures curve moves only by parallel shifts up or down, then I can trade any futures contract, any one of these ones, such in a quantity such that this total sums to zero, and then I'll be hedged against parallel shifts in the curve. So if the futures curve moves only by parallel shifts, where if one futures price goes up by $1, all the other ones go up by $1 as well. If my total number is zero, then I'm always hedged, even if all my individual contract deltas aren't zero. Now that's a model of how curve moves happen. It's a particularly simple model, but it's a model nonetheless. That said, futures curves typically don't really move with parallel shifts up and down. Futures prices aren't 100% correlated, and also the front of the curve typically has a higher volatility than the back end. That is, futures prices tend to get more volatile as they approach settlement. So this simple parallel shift model isn't really that good. So how do we come up with a better model? There are two standard quantitative techniques that we can apply here. The first one is called a factor model. So in a factor model, we assume that there are a small number of kinds of curve shock that can happen. When the futures curve moves, the model is that the futures curve moves is a sum of a small number of shaped curve shocks, each one weighted by some random weight. For example, in a one-factor curve model, there's only one shaped curve shock. And a parallel shift, like we just looked at, is one kind of one-factor curve model. And that just happened to be one where the shape of the shock is the same for every futures price. It's a parallel shift. A better one-factor model is one that reflects the fact that the front of the curve moves more than the back. So maybe we have an exponentially damped shock. That means like when the market moves, it bumps the futures curve up or down by that exponential shock with some random number weighting the shock. Sometimes that random number maybe is like small and positive, and the curve moves up a bit more in the front than in the back, but only by a small amount. Sometimes that random shock, that random number is negative, and so you get a negative shock to the curve where the front of the curve moves down by a lot. The back of the curve also moves down, but not by as much as the front. So that's a one-factor model. In a one-factor model, all the futures prices move with 100% correlation, but they have different volatilities. So it's better than a parallel shift, but not that much better. We're not modeling the fact that the correlation between futures price moves are really less than 100%. So you can then generalize that model. Instead of having just one factor, maybe there's 2 or 3 different curve shocks, 2 or 3 different factors. And maybe those the shaped curve shocks are exponentials, but they all have different exponential weights. When the curve moves, maybe you have 3 factors, you choose 3 different random numbers to weigh each one of those shocks, and then you sum them up to get the total shock to the curve. And having more than one factor means that the correlations between moves and futures prices are less than 100%. Let's call that number of shocks M, which is much less than the total number N of futures prices. So this is dimensionality reduction. It reduces the number of risk dimensions from N, which might be 20 or 30 for a single market, down to M, maybe 2 or 3 for a single market. And that's kind of what we were looking to do. And the idea here is that if there are M risk factors only, 2 or 3 risk factors, then you can hedge all your curve risk by trading just M futures contracts. So if you imagine that most of the move in the futures curve happens from just like 3 factors, then you can choose 3 different futures contracts and hedge all of your curve risk just by trading 3 different futures. You don't need to use exponentially shaped shocks. That's a common choice, but any function will do that represents curve moves somewhat realistically. But these shocks are functions of parameters. You know, for exponential shocks, the parameters are the strengths of the exponential decay for each factor. The idea then is that you calibrate the model by looking at historical correlations and volatilities, the covariance matrix, and you find the model parameters, those exponential decay coefficients, for example, that give you the best fit to historical dynamics. So typically this might mean looking at like one-day returns for all of your N futures prices over some longish historical window, like a year. And then you calculate the matrix of historical covariances, and those are the covariances of one-day returns of futures prices of these N different tenors. So that's the historical covariances. You just get that by looking at historical time series data. In the model, though, in our factor model, for a given set of model parameters, the model will also tell you what it thinks that covariance matrix should be, the model covariance matrix. And then calibration for the model involves finding the set of model parameters where the model covariance matrix is as close as possible to the historical covariance matrix. So that's factor models. The second quantitative technique we're going to talk about is principal component analysis, or PCA. The basic idea is pretty similar to factor models. So you assume that when the futures curve moves, that move is the sum of a small number of curve shocks, of these shaped curve shocks, weighted by some random numbers. The main difference with PCA is that you don't need a model for the shape of the curve shocks. Like with factor models. In factor models, we assume, say, that the shaped shocks were all sort of exponentials with different exponential decays. In PCA, the shapes of those curve shocks are outputs of the analysis. The technique tells you those best fitting curve shocks, along with which one of those shocks are the most important. The input data, though, for PCA is the same as it is for factor models, that historical covariance matrix, the historical covariances between one-day moves of futures prices of different tenors. So the output of PCA is this list of curve shocks, and for each curve shock, a weight. The shock with the highest weight is the most important shock, the one that contributes most to curve moves. The second highest weight is the second most important curve shock, and so on. So if there's N futures prices, PCA gives you N different curve shocks and N different weights. And then the model part of it says, let's throw out all, I end up with N different curve shocks. I'm going to throw out everything except for the M biggest, like the top 2 or 3 biggest curve shocks. And I can figure out which the biggest are by the weights that come out of the PCA analysis. And then I'll assume that when the curve moves in the future, I can do pretty well by approximating those curve moves with just M-shaped shocks rather than the full N. And again, like with factor models, so PCA lets you reduce that number of risk factors from N, something like 20 or 30, for a market down to a small number M, which is like 2 or 3. And then you can hedge your risk to the full curve with trading just 2 or 3 futures. Typically, when you run a PCA like this, the top 3 factors look kind of qualitatively similar. The first factor looks like a parallel shift, but where the front of the curve moves more than the back of the curve. Again, reflecting the fact that forward prices get more volatile as they get closer to settlement. The second factor looks like a curve tilt, where the front of the curve goes up and the back goes down, or the front goes down and the back goes up. The third looks like a bow move, so the front and the back of the curve go up and the middle goes down, or vice versa. Like I mentioned, PCA and factor models are qualitatively similar. They both model moves in the futures curve as a sum of a small number of shaped curve shocks, and they're both calibrated to this historical covariance matrix, the historical covariances of one-day moves in futures prices of different tenors. They're not exactly the same, though. In PCA, the shape of the shocks is an output, whereas for factor models, it's an input, like maybe an exponentially decaying shock. What that means is that PCA is more flexible in terms of the kinds of shocks that it can represent. It can match more complex kind of shaped shocks than factor models can. But that's a double-edged sword. The flexibility of PCA means that it can be more sensitive to things like bad data points in your historical data set, or maybe big one-day moves in the historical data set that aren't representative of standard future market moves. That said, it's a really useful tool for generating scenarios. So let's take a look at that. So here's an existing Beacon application, our market stress generator. It lets you do ad hoc scenario analysis of how these kind of typical curve shocks affect your portfolio. So it lets you choose which portfolio you're running against. It lets you choose which markets to look at, and then you can run a PCA and then do it kind of ad hoc testing. So here I've got the shape of the curve. I've also got, for the portfolio that I'm running against, the value. So the current value is $2 million. The shock value is the same because I haven't applied any shocks yet, so the difference is 0. Now I can go and do ad hoc things like experiment with scenarios where the curve is shocked by these different principal component shocks. So if I move the first one, here's a move in the first principal component, and you can see the shock again is kind of like a parallel shift, except the front end of the curve moves more than the back end of the curve. This comes out of the analysis. This wasn't put in by hand. This is an output of the principal component analysis. So here I've made some money when the first principal component goes up. If I move it the other way, principal component goes down, I lose some money. So I'm like long delta to this first principal component. I can look at the second component now. This is like a tilt shock. So here I've done a shock up for this thing where the front end of the curve moves up and the back end of the curve moves down. And I can see I made some money on that shock. If I make it go the other way, move the front of the curve down, back end of the curve up, well, in that case, I'm also making money. So in this case, this portfolio that I'm looking at is long gamma to the second factor, to this tilt factor. So now the third factor, this is like a bow shock. So you can see it moves the front end of the curve up, the middle of the curve down, back end of the curve up. Here I'm making some money on a move up in that factor and losing some money down. So I'm again long that third factor. So this lets the risk manager do ad hoc analyses on a commodities risk book, understanding what might happen in different curve scenarios, but curve scenarios that are motivated by the standard ways that historically curves have really moved. So rather than trying to sort of handcraft curve scenarios in ways that you guess they'll move, principal component analysis lets you find how curves really have moved, the most important ways curves have moved, and apply those. Oops. All right, so PCA and factor models give you a model-based way of reducing risk dimensionality to the point that a human risk manager can apply realistic shocks to a portfolio and see how it might react and understand those. They're calibrated to historical data, but to a specific kind of historical data, the covariance of one-day moves of futures prices of different tenors. So that's good for understanding risk in standard market conditions, which is good. Mostly we operate in standard market conditions, so it's good to understand those risks. But they're not great for modeling tail events, that is, those rare but large market moves. And those are the ones that often give you the biggest one-day returns, either positive or negative. So it's good to understand your risk to that kind of scenario. There's lots of ways to approach that kind of analysis, so we'll talk about a couple. The first one is value at risk, or VaR. VaR looks at historical one-day moves over a long historical window, applies each one of those historical one-day returns to the current market, and then for each one of those scenarios calculates the P&L and then looks at the distribution of those P&Ls. P&L means profit and loss, by the way. So let's look at a value at risk report. Here's sort of a typical one. So the idea is, the green bars here are a histogram of your profit and loss, your P&L outcomes. So sometimes you lose money on the left-hand side, sometimes you make money on the right-hand side. When we're looking at tail risk, we're looking at sort of the left-hand side of the distribution and want to get a feel for that. So value at risk is one way of doing that. So here in this risk report, our 95% one-day value at risk number is $1.79 million. What that means is 95% of the time, that's represented by this red bar here, by the way. So 95% of the time, our P&L outcomes are kind of to the right of this red bar. We lose less than the value at risk. We lose less than $1.79 million. But 5% of the time we lose more. There's other statistics like expected shortfall that says, conditioned on losing more than the value at risk, how much do I lose? So you can run these risks with like 95% confidence or 99% or 99.5% to get different views on tail risk. Another way to look at tail risk is to pick out like particularly interesting big historical moves and apply those to the current portfolio and see what would happen if a similar move occurred today. So let's figure this out, like how we might actually implement this kind of historical scenario analysis in Beacon. So what we want is a tool that lets you choose a window for your historical move, like a start and end date, then picks out the curve shock that happened over that range, and then applies that shock to the current market and figures out how much you make or lose. But one of the great things about Beacon is how it lets developers build applications for their business, even if they aren't awesome at UI stuff. So Beacon has an application framework built into it called Glint that lets you define an application in Python code and then hit F9 and turn it into a proper production web application, all without having to know all the details about how web applications work. So let's flip over to Beacon's IDE, our integrated development environment, and see how you build this application in a couple hundred lines of code. All right, so here's the Beacon IDE. It's based on Visual Studio Code with a bunch of specific Beacon customizations for things like code deployment workflows. This here is the section where you write your code. It's also got a Python terminal that lets you kind of interact with the environment. One of the reasons, by the way, that Beacon is so powerful is because this development environment is part of the production risk management system. It's not like a separate R&D environment that's completely standalone. What that means is that you can access, for example, like all your production data while you're developing, market data history, reference data, trades, positions, historical positions, and all that kind of stuff. So for example, I can, load up a little portfolio here. I'll load up a test portfolio. Oops, spelled that wrong. Here we go. So now I've got a handle to this book. I can do things like say, what's the price of the book? Then go and calculate the price based on whatever market environment I'm in here. I can look at the positions of the book, right? So here, this little book has, 10,000 lots of a particular futures option. I can also go and play around with history. So I can move to some historical date, say August 25th, and I can ask for the price of the book again, and it'll show me the price of the book in that state. So it gives me all these nice high-level ways to kind of play around with the real production environment as a developer. Now, things are formatted very nicely in here. That's kind of for applications. But the point is developers have access to the full risk management system environment while they're doing development, and that lets them properly test their code against real data and trust that when they push out a change into production, it does sensible things because they were testing against the same data. All right, so let's look at building this application. We'll use Beacon's Glint UI framework for this, which follows the standard model view controller framework. So in that, you've got a model object that holds all the application data and does calculations. The view is like the user interface front end, so what it looks like, and then a controller is something that links the two together. So the first thing we're going to do is build a model class. So here's this app model is the definition of the thing. It inherits from grommet.object. Grommet is our dependency graph framework, which is a really powerful tool for linking financial calculations together. In Glint, in the user interface stuff, the graph is the technology that links different parts of the application together. So if you change like, a historical date that defines a historical scenario, the P&L field will automatically update in the UI because it's connected together by the graph. Some of these things are tagged as can set. Those are data values. Other ones are calculated, like priceable names here. If I want to go and have like a drop-down list of portfolios that people can select from, I'll have a calculated value that shows the list of all those things. Again, it's cool that this runs like in your production environment, so you can run this against real production data. Here's another method, curve shock. Curve shock. So curve shock is the bit of analytics that picks off the curves on the start and end date that we want to use for our historical window, figures out the shock, and then applies it to the current market. Here's another method, P&L. This is the thing that figures out the P&L due to applying that curve shock. And again, it uses a dependency graph that makes it really easy to code this stuff. So I just say like I've got, the base price, that's the price without doing the curve shock. And then in a grommet layer, which is like a layer of the dependency graph where I've applied my shocked curve, I can go in this after the price of the book. So it's really easy to do calculations like that using the dependency graph. Here's a function, get views. This is the thing that defines the user interface. So again, you don't have to know JavaScript or HTML or any of that kind of stuff. All you need to do is be able to write Python code to lay out a user interface as a grid of widgets, like rows and columns. So here I've got some rows and columns with some labels, some drop-down lists, some date pickers, a plot to show the curve shock, a thing here to show the P&L, and then the main function that pulls the model and views together and rolls it into an app and runs the app. So let's just run that. I'll hit F9, and on the fly that translates that Python code into a real web application, not a super fancy web application. So here I can choose the portfolio, which market I'm running against, the start and end date. It'll show me the curve shock that it's going to apply, and then it shows me the P&L for the book that I'm pointed at due to the shock. So here I've got, from the 23rd to the 24th of August, it's showing me, that there's a tilt shock in the market. But then a risk manager can go and investigate different things. So let's say I want to go and look at some bigger historical move, say the one from March 1st to March 2nd, where there's a big move up in oil prices. The front of the curve went up like 6%, the back like 3.7%. It's got this kind of weird wiggle in it here. This isn't something that you would easily reproduce through PCA or through a factor model. And I can go in this sort of experiment and see what would happen to my portfolio if that same move happened today. Now, this is a particularly simple application, and it's just running in my development environment. It's not running in production, so a trader couldn't run it, for example. One of the cool things about Beacon, though, is it includes the trading system. So Beacon's IDE has tools that let you do fast atomic code releases multiple times a day, especially for new code. So a quant or a developer could build the first version of this app, deploy this initial version out into production, get a trader to play around with it, get some feedback, make some changes, re-release it, get some more feedback, make some more changes, re-release it, and do that multiple times a day. So you can have this kind of iterative development model that works really well on a trading desk, but still do it in your production risk management system. So Beacon isn't just an R&D environment. It really gives developers the tools to be a much bigger part of the business and be a lot more productive. So that's it. We saw how the Greeks are these fundamental risk metrics that everyone should look at, but how there's so many of them that they're often hard to use in practice. Then we looked at different ways of reducing the number of risk dimensions so that a human can kind of reasonably comprehend them, principal component analysis and factor models. We looked at an existing Beacon tool for running a portfolio through ad hoc PCA scenarios. And then we built a tool to do similar things for historical scenarios. So that's it. I'm happy to field some questions now if anyone has them, but also feel free to reach out to us here at Beacon. We'd love to continue the conversation. So happy to take some questions now if you want to post them in the chat. All right, one question. Does this mean that we should move away from Greeks as standard risk metrics? Absolutely not. So Greeks show you your core risk exposure, your kind of granular risk exposures. And you should always look at those because you want to know where you have concentrated risks. But like we discussed, there's often so many of them that they're hard to summarize, and that's where these dimensionality reduction techniques come into play. All right, another question. How can you release code multiple times per day in a bank? There's so many bureaucratic hoops to jump through to satisfy controls. It's a great question. Well, in this case, it's because it's a brand new piece of functionality that nothing else depends on. So it doesn't need as strict controls as like a core production application that lots of people already depend on. Beacon includes in it a software development lifecycle, an SDLC framework that reflects real world controls. And it's based on what myself and my co-founder built at Goldman Sachs, at JP Morgan, and Bank of America. And it works really in production for all those gigantic banks, and it'll work for you too. You know, one of the first things we do with a new client is talk to people in their control functions to help them understand why this approach does satisfy their requirements. But it also means that you can make lots of quick changes in production for brand new functionality while keeping core production functionality moving more slowly and more controlled. All right, maybe the last question. What if you've got a concentrated spread position between like two neighboring futures contracts? Won't this sort of dimensionality reduction stuff, PCA and factor models, hide that spread risk? Absolutely, yes, it will. That's why they're not perfect. They're just one tool in your risk arsenal. That's why you always want to look at your Greeks reports, because you know you'll in the Greek report you'll see a big spread position kind of standing out and be able to identify it. And in that case, you know, PCA risk and factor model risk might not be the best way to hedge your portfolio. Okay, so I think that's where we'll end it. So thank you again, everyone, for joining. And please do reach out to us if you do have any other questions or want to learn more about Beacon. Thanks, everyone.